Get ready. Something massive is about to hit. It's going to shake America to its core. But if you think China is immune, just hang tight. What you're about to see is mutual economic destruction at the highest level. Now let's turn to Apollo, because they're saying, look, this is all about the U.S. consumer as we're now facing headwinds. But the problem is we've been facing headwinds for years. We've been seeing the U.S. consumer continue to struggle and fall behind due to inflation. But what's coming now out of China is going to shake and rattle our economy in a way we have not seen in years. Let's take a look, because he says container ship departures from China to the U.S. are now collapsing, and this is a major problem. Think back to not too long ago what happened in the port of Los Angeles and Long Beach. Container ships continued to drop off, and what happened? Work dried up. And it wasn't just the dock workers that didn't have enough work. For long, it started to spread all across the inland and there in Los Angeles area and all up the supply chain. We started to hear from truckers saying, look, we're not getting loads and we don't have the cash or credit to sustain our business model. And this is a major problem because, as we've noted, where shipping goes, the global economy follows. Let's take a look, because you can see the container ship count in terms of used capacity in blue against total capacity in green. And you can see used capacity is plunging, and that's bringing total capacity down with it. And if you think back during the pandemic, what was the major issue in the shipping industry? They didn't have enough ships. Now the problem is we have too many. We have way too much capacity, and that's going to be a thing we're going to hear over and over. In fact, it's such an issue in China, they created a new word for it, saying that the problem with their economy is there's too much capacity. And again, it's not about capacity, it's about demand. In this case, we're continuing to see the global economy slow, but the issue is what's coming for U.S. workers is going to be devastating. Let's take a look at the imports of goods and services, this into the United States in blue against the unemployment rate in red. And one thing we've noticed is where imports go, well, the demand for labor falls. And you can see as imports come crashing down and contract below that horizontal black line, the unemployment rate rises. We see that going into the global financial crisis. Now, we didn't see that around 2015 because the U.S. economy was strong enough. But this time, let's look what happened. Back in 2024, you can see as imports came crashing down, the demand for labor went with it and never recovered. Now the problem is we're seeing a huge drop off in container ships, and the situation's only going to get worse, because not only does it mean there's going to be rising unemployment in China, it means there's going to be rising unemployment right here in the U.S. Now, Apollo says the decline in total shipping in the U.S. is pulling down on consumer spending, but I think it's the exact opposite. And they note that as daily shipping into the U.S. drops, will retail sales follow, suggesting that perhaps the reason that U.S. consumers aren't spending is because they can't get their hands on the goods they want. Now, I think it's the exact opposite. I think it's the U.S. consumer that's the driving force of the global economy here, and I think U.S. consumers are tapped out. You know, we continue to see their paychecks shrink relative to inflation. But look at just things this summer. We're seeing air conditioning bills, electric bills, they're going up. Student loan repayments are coming back. And what are we seeing even for wealthier Americans? The delinquency rate is rising. But let's take a look at this next chart, because it's a very clear sign that what you see is when the American consumer pulls back, well, the world pulls back with them. Here we can look at real retail sales shown in red against that's inflation adjusted. And you can see as it slows down, well, imports continue to rise and then they roll over and follow. See, the same thing happens going into the global financial crisis. You can see it post-pandemic, and we are already seeing signs of it now, because the expectations were, due to all this front rate of tariffs, that U.S. consumers were indeed strong financial positions, that they were ready to come out and spend. But the problem is they were coming out and spending to get ahead of the tariffs, because all the consumer surveys are telling us that not only are Americans worried about their jobs, they're worried about their incomes on top of it. They're seeing their incomes drops. They're worried about losing their job, and they know if they lose their job, the odds of getting another one right now are slim to none. The bottom line is that U.S. consumer spending is facing headwinds from tariffs, although we quite haven't seen any pass-through of that in consumer prices. Relatively high interest rates, and well, the Fed might fix that a little bit in the months to come. Student loan repayments starting, and here's an interesting twist. Deportations lowering the number of U.S. consumers. Now that's interesting because it's something I didn't consider, but it's a very real issue here. If we have less people to spend, Well, that means, of course, the inventory levels are going to stay elevated. The longer those inventory levels stay up, that means at the manufacturing level, you're going to see capacity drop, the demand for employees drop, and then it's going to spiral all through the supply chain. And that's exactly what we're seeing in these imports from China. It's already telling us this is happening, and the problem is it's going to be devastating for U.S. consumers as they face an even bleaker jobs market. But just because we're likely to face a globally synchronized recession doesn't mean your trading account has to go down with it, because we're changing the way people trade. Now, this is from our new Metre strategy. This trade went out to our CTA Timer and Momentum Timer Pro subscribers on the 6th. We told them to buy PHO on the open. We sold them to raise our stop loss levels along the way, and on the 14th, they got stopped out for a 2.08% gain. And here's the great thing about our system. We tell you what to buy and when to buy it. You make the choice, and then we tell you what your stop loss levels are and how to raise them. You don't have to sit in front of your computer all day. You don't have to look at charts and graphs and look at all these things. We give it all to you. And now, how do you get in on this Metre strategy? Well, all you do is have to pick either one of the reports, grab those links in the description below, use the coupon code for your free 30-day trial. Stay tuned to the end of the show to find out more. Because let's take a look at the real impact for U.S. consumers. And again, it's not the fact that there's a lack of goods for us to buy. The issue is it's all about paychecks. We can see very clearly that as real retail sales, still shown in red, decline, it's because paychecks are declining. Let's take a look, because we have average weekly hours of production in non-supervisor employees in blue, and you can see it leads retail spending. It makes perfect sense. As paychecks shrink and people get fewer hours, at some point their spending comes to an end. Now, in the onset of it, what happens is people tap their credit cards because they think, well, this is just a slight pullback in work. But then when it becomes persistent, then their spending drops. Now, we can see that happen post-pandemic here. And what's the issue is that, well, why retailers and corporations were hoping demand was going to surge higher, it didn't. And it didn't because what we're facing is consumers and workers who are not getting the hours they need to sustain their spending, to buy all of this unsold inventory. And what that means is, again, as this backs up from the supply chain, again, it's from the consumer up, what you find out is we're going to see fewer ships from China, fewer ships from all over the world, and that means a lot less demand for not only U.S. workers, but workers all across the planet. But as we turn to this Friday, does this mean the Fed's finally going to react? Well, I'm not so sure they will. As Powell has reason to hedge, Jackson Hole signal as data zigzags. Now, I want to understand this is the Fed's summer retreat. This is not an official meeting, although on Friday we will hear from various Fed speakers, particularly Fed Chair Powell. Now, oftentimes you'll hear them just talk about their monetary policy in general, but occasionally they use this as a lead of where they're going with rates. And that's what the world's going to be watching. Is Powell going to signal a September rate cut, or is he just going to pass on that? But there's some problems here that are holding them back that I think Powell's going to mention. The trouble is the key economic indicators aren't all pointing that way. A couple of weeks ago, when the latest jobs report revealed a slump in hiring, the case for lower rates appeared all but closed. But here's the Fed's excuse, and I want to understand how they're going to position this, is they're going to say, look, we think the labor market is going to turn around because consumers are continuing to spend. The issue isn't consumers, it's businesses didn't want to hire due to policy uncertainty. And now as the trade war is wrapped up and the tax cut was indeed held through and passed, that we're going to see hiring from businesses. So from the Fed perspective, they may want to wait on that. I think that's what we could hear from Powell. Then came the sharpest spike in U.S. wholesale prices in 3 years. Fuel for that concern about tariff-led inflation that's kept Fed officials on hold so far this year. And I think that's the real issue here that we're going to hear from Powell. Let's take a look at this next slide, because what do we see? Producer price index in red against the consumer price index in blue. And you can see the beautiful relationship between the two. Where producer prices go, consumer prices usually follow. But there's a problem. Since late 2023, producer prices have been on the rise. Consumer prices have been on the decline. And what the Fed's going to be concerned about is this rise in producer prices is eventually going to get passed on to U.S. consumers. But it isn't always the case, because we can note there's been some inflection points around 2011 and 2022 where producer prices continue to rise, but consumer prices didn't go with it. The reason why It's because U.S. consumers couldn't afford higher prices, so producers started to eat it at the margin and realized that that was not a sustainable trajectory. Now the question is, we already know consumers are struggling here, but will producers push that on into higher inflation? That's the risk the Fed is facing here, which could give Powell any reason to say, I'm not locked in on a September cut. Even though I expect him to generally point to lower interest rates at the next meeting, referring to the September Fed meeting, I do expect him to precondition it on a very data-dependent message. This from Jonathan Pingle, the chief U.S. economist at UBS. He says, I don't think he's going to lock it in, and I do agree with that view. Jonathan, I think you're spot on in your assessment here. I think Powell's going to say, look, we kind of want to lower rates, but we're very data-dependent now. Keep in mind, they were data-dependent on expectations, and you're going to see him flip back to the look back, that old standard in data. He's going to say, look, we're going to rely on that because I think the labor market could turn around. I think inflation could push up, and I don't want to see this thing spiral out of control. But what we're going to then look at is the bond market's reaction. Right now, it's suggesting there could be a cut coming. Two-year Treasury yields the most sensitive Fed policy plunge this month as traders swung toward pricing in a quarter-point cut in September. Those bets took off after the unexpectedly bad July employment report, which also revised payrolls for the prior months downward in a major way. And they've only been dialed back slightly in light of last week's nasty inflation surprise. And as we look at two-year yields, you can see clearly in red that they lead the federal funds rate in blue lower. Now we've seen the two-year yield drop and the Fed didn't react, and since then two-year yields have pushed up a little bit, only suggesting a potential quarter basis point cut, but it's not falling off the cliff just yet. But one economy that is, well, it's China's. As China's cement slump signals the end of a 21st century building boom. And remember, this drop in shipments coming to the U.S. is not just a U.S. problem, it's a China problem. What you're seeing is two major economies starting to crumble here. And again, this is just a sign that demand around the world is weakening. Consumers all around the world are spending less. There's way too much capacity that's going to end up leading to deflation. The problem here is there's a massive amount of debt, and this is why we're sowing the seeds right now for a major financial crisis. Cement production posted its weakest July for any year since 2009 as an unresolved real estate crisis and tepid infrastructure activity weigh on construction. Now, I love this language. This is so good. Let's look at it again. It says unresolved real estate crisis, meaning we can't get people to buy our homes, and tepid infrastructure activity, meaning why are we going to build things if no one's going to buy them? In fact, as we've talked about recently, China has a Detroit-sized city equivalent amount of unsold homes. Now, that's not a crisis, that's a mismatch of supply and demand. But we're not immune to that either, because U.S. builders are sitting on the largest unsold amount of homes of brand new inventory they have since the financial crisis. So you're seeing major problems on both sides of the fence. The cement figure was just one among a bundle of data points released on Friday, showing a sharp deceleration in the world's number 2 economy, indicating that exactly what we saw in that chart about shipping is exactly what's happening in China's economy. The problem is it hits them first. Remember, they're the world's largest exporter. They are the factory of the world, and then it hits the world's largest importer. That's us. Always hits us with a lag. Annual output rose every year from 1990 through 2014 to build the skyscrapers, transport networks, and sprawling real estate that define modern China's urban landscape. But peak cement can be pinned in the month of May of 2020, which is interesting because that's the exact same time we saw the U.S. economy start to slow down. So you can see we're a globally synchronized economy, and that is, again, a major problem here. And that goes back to when Beijing was rolling out pandemic-era stimulus and the property crisis was yet to unfold. Again, just more evidence that all of the stimulus that these governments do, rate cutting, monetary policy, none of it actually works, because in the end of the day, it's all about consumers. And right now, due to inflation and shrinking paychecks, consumers just don't have the ability to keep spending. In a panic move, China's exports of rare earth products, including magnets, extended their recovery in July, months after Beijing threatened a disruptive global shortage by crimping supplies to fight a trade clash with President U.S. Donald Trump. Now, remember at the time, we said, look, this was a power move here, because if U.S. manufacturers don't have these magnets and rare earths, they can't produce, factories get shut down. And then all of a sudden, what happened? U.S. consumers figured out that they're going to cut back their spending too, and now it's impacting China. All of a sudden, they're changing their tune here in a big way. Shipments jumped last month to reach their highest since January, well before China leveraged its dominance of rare earths to hit back at Trump's punitive tariffs. Beijing agreed to resume flows to U.S. as part of a trade truce with Washington, and more along the lines it probably had to do with the fact that if the U.S. economy goes into recession, well, China is going into a recession. Now they're trying to reverse policy here, get U.S. consumers back spending. I think it's too little, too late. But meanwhile, stocks continue to press higher. But what's the magic force behind this? Well, it's everything to do with earnings upgrades. Because we hear in the comments, a lot of people say, well, Steve, the economy can't be this bad because look at the stock market. It's great. Forget rising unemployment. The stock markets go up. Forget the fact that you're seeing manufacturers start to cut back on production. The stock market's going up. And the reason has everything to do with the fact that Wall Street wants prices to go up. They want people to keep buying. And here's why. The sheer number of what-ifs caused analysts to reduce earnings estimates months ago on tariff fears, and what they did is they lowered them to a level they knew companies could jump that hurdle. And what happened? They did handily, and that really unleashed a lot of bullish fever, and it brought even more money into the markets. But that is going to change in the quarters to come. A Citigroup index that tracks the relevant number of U.S. earnings per share estimate upgrades versus downgrades is its highest since December of 2021. And what you're seeing here is analysts saying, look, everything's okay. The stock market is up and people want to keep buying. So we're going to raise those expectations for future earnings. Remember, the bar was set very low last quarter. Going forward, it's going to be set at high levels. The risk is that companies aren't going to be able to meet those targets. And as we come all the way full circle, right back to that beginning chart of imports, you can see it's going to have a major impact on earnings. And we know where earnings go, stock prices follow. Let's take a look at imports of goods and services shown in blue against corporate profits after tax in red, both shown on a year-over-year rate change. And you can see the great relationship between the two. And what are we facing right now? A complete collapse in imports. We know it's likely to get worse. We know U.S. consumers are cutting back on their spending in a major way. And what that means is for the quarters to come, companies are going to have a big problem trying to hit these lofty Wall Street targets, which is, again, exactly what Wall Street wanted. You wonder why hedge funds were selling. And again, we talked about this on Sunday. Part of the reason is they want retail to buy at the top, so all of those big insiders like hedge funds and institutional investors can dump into that flow. But just because we're likely to see a correction here that could turn into an all-out bear market doesn't mean your investment accounts have to go with it. Let's talk about our Metre strategy here, and it's an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 times more frequent buy signals than individual strategies on their own, while maintaining high quality through multi-strategy consensus. Now, how does it do that? It pulls data from the Bravo 9, Turtle Trading, 200-day cross, Golden Cross, Trend Pullback, RSI Divergence, 520 EMA cross, Channel Trading, and Fibonacci retracement. And what it's doing is optimizing for swing trades. As a target hold period of 2 to 15 days, it generates over 155 signals per year and has a success rate that tops any of those strategies on their own, of 55%, all designed for fast profit taking. Now, here's the best part. Right now, this is included on either one of my reports at no additional charge. Now, if you want to trade against the machines, take a look at that CTA Timer Pro. Find some great entry points. If you love to trade momentum signals, well, then you want to grab Momentum Timer Pro. But no matter which report you pick, you get the daily report. You get the tradable signals, including the meta strategy trades. You get my opinion on what I think are the best trades. You get risk control levels. And my friends, this is something other people don't give you. You get a full tracking of all our open trades and returns, a weekly update. And again, here's the best part. You don't even have to put a dime to try out these reports. All you have to do is grab those links in the description below, use a coupon code, and you get a free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.